Welcome to Insights That Matters.
Right.
We love taking these deep dives into really fascinating subjects and unearthing those valuable insights along the way. Today, we're diving deep into the world of Mohnish Pabrai. And I have with me, well, an expert on investment strategies, really excited to get their take on all things Pabrai.
It's great to be here. I find Pabrai's approach to investing, well, quite intriguing, particularly because he doesn't just follow those principles, he embodies them. You could say he takes them to a more concentrated level.
So we're talking about a man who sold his IT business back in the dot-com boom.
Yeah.
For a cool $20 million, or, roughly about 160 crore rupees. And instead of, hitting the beach, he goes and founds Pabrai investment funds.
Yeah.
And we're not just talking, decent returns here. His returns have been,
phenomenal.
Hitting over 500%.
Yes. And I think that's precisely what makes this deep dive so interesting.
Right.
It's not about just getting rich quick. It's about understanding the strategies of someone who's built his success on, smart long-term thinking, but also a healthy dose of, contrarianism.
Yeah. Now, Pabrai calls his approach Dhandho investing, which is a term that signifies endeavors that create wealth. So it's about looking for those low-risk, high-return opportunities, almost like, finding a 50 paisa coin for like 5 rupees in the share market, as they say.
And the beauty of Pabrai's approach is, well, it's simplicity, really. He avoids complexity. Often talks about not needing those elaborate spreadsheets or complicated financial models. If an investment decision can't be explained simply, it's probably too risky.
It's about keeping things simple and focusing on, what you understand. And speaking of simplicity, Pabrai is a big believer in, well, he calls it shameless cloning. He openly admits to borrowing and adapting those ideas from successful investors, primarily, of course, Warren Buffett.
That raises an interesting point, though, doesn't it? Is it really cloning if you're applying a concept to, say, different businesses or sectors, in your own unique way? Pabrai's approach highlights, I think, the power of learning from the best.
Right.
So by studying those who've achieved what you aspire to, you kind of accelerate your own understanding and growth.
It's like he's recognizing those proven models and applying them intelligently, rather than, blindly copying every single trade.
Yeah.
For example, Pabrai structured his investment fund to mirror the model that Warren Buffett used during his early partnership days.
Exactly. It's about extracting those underlying principles and frameworks, then applying them to your own circumstances and opportunities. It's like, learning a martial art. So you study the techniques of a master, but ultimately you develop your own unique fighting style.
I love that analogy. Now, another key principle in Pabrai's Dhandho framework is what he calls the heads I win, tails I don't lose much approach. So it's all about minimizing that downside risk.
Absolutely. This emphasizes Pabrai's focus on, well, downside protection. So he's not interested in those risky bets that could, wipe out his capital. He looks for investments where the potential for loss is, minimal, while the upside potential is significant.
So how does he find these opportunities? Well, Pabrai has this intriguing concept of the hidden PE of one. It's essentially about finding companies that might seem expensive on the surface, but have the potential to become massively undervalued in the future.
This is where Pabrai's deep research and understanding of those business cycles come into play. He's not just looking at today's price-to-earnings ratio. He's considering the potential for a company's earnings to grow significantly, and that would drive that PE ratio down, even if the share price remains the same.
So it's like finding that hidden gem in a crowded marketplace. So the current valuation might not scream bargain, but the potential for future growth, that's where the real value lies.
Exactly. It's about identifying those companies with strong growth potential that the market might be overlooking, because their current valuations don't fit that, typical cheap stock mold.
For instance, Pabrai talks about Petronet LNG, a company that's currently trading at a PE of around 6.6. But projections indicate their profits could increase by a whopping 200%. Now, if that happens, their future PE could drop down to 2.2. making it a steal in retrospect.
And this brings us back to the importance of patience.
Right.
Pabrai is willing to wait for those earnings to materialize, for the market to recognize the true value of the business. This long-term perspective, I think, sets him apart from many investors who are constantly chasing the next, hot stock.
Speaking of, going against the grain, Pabrai isn't afraid to invest in what he calls the hated and unloved areas of the market, the sectors that most investors, well, they tend to avoid.
This contrarian approach is a hallmark of value investing. So when a sector or company falls out of favor, fear and pessimism, they can drive prices down far below their intrinsic worth. And this creates opportunities, I think, for those willing to go against the herd and see the value that others are missing.
So sometimes the best place to look for gold is where everyone else is afraid to tread. Interesting.
In a sense, yes. It's about recognizing that market sentiment can create distortions, and those distortions often present the most compelling opportunities, I think, for value investors.
Pabrai's investments in Turkey and coal companies definitely raised some eyebrows, but he saw potential where others, well, they saw only risk.
These sectors were facing significant challenges, right? Economic volatility in Turkey, the global shift away from coal. However, Pabrai recognized that within these broadly unloved areas, there were businesses with strong underlying fundamentals and that were being unfairly punished by the market.
So it's not about, blindly investing in anything that's out of favor. It's about, digging deeper, doing the research and identifying those hidden gems that have the potential to really shine.
Precisely. It's about understanding that there's a difference between a company facing temporary headwinds and one that's truly in decline. Value investors like Pabrai, they're skilled at differentiating between the two.
Now, all this talk about unearthing those hidden gems and tuning out that market noise brings us to another crucial element of Pabrai's approach, focus. He draws a parallel to the story of Arjuna, the skilled archer from the Indian epic, the Mahabharata.
That's a brilliant comparison. The story of Arjuna hitting that fish's eye while ignoring all those distractions, it perfectly illustrates Pabrai's point. It highlights the importance of unwavering concentration when making those investment decisions.
Yeah. In a world that's, bombarded with information, it's so easy to get sidetracked by, I don't know, the latest news headlines, expert opinions, geopolitical events, or even just the general chatter of the market.
Indeed. The financial world is full of those distractions, really, designed to pull your attention in a thousand different directions. But Pabrai reminds us that the most crucial element is understanding the fundamentals of the businesses you're investing in. Everything else is just noise.
So block out the noise, do your research, and focus on the long-term potential of a business rather than getting caught up in those short-term market fluctuations. Easier said than done, right?
It definitely takes discipline, but that's what separates successful investors from the rest. They can maintain their focus, stick to their principles, and avoid getting swept up in that emotional roller coaster of the market.
And I think that's a great point to pause and reflect on what we've covered so far.
Yeah.
We've delved into Pabrai's Dhandho approach, the power of shameless cloning, the importance of downside protection, the concept of the hidden PE of one, and the art of finding value in those unloved sectors.
And there's still much more to uncover. In the next part, we'll delve deeper into some of Pabrai's specific investment choices and explore his insights on the importance of, simplicity and patience in achieving long-term success.
We'll be right back. Welcome back to Insights That Matters. We were just discussing how Mohnish Pabrai seeks out those hated and unloved corners of the market where others fear to tread. Can you give us some specific examples of how he puts that into action?
One example that comes to mind is his investment in Rame Industries Limited.
Okay.
This company produces petroleum coke and coal tar pitch. Now you might think, coal, isn't that a dying industry?
Right.
And you wouldn't be entirely wrong. The world is shifting towards cleaner energy sources, and coal is, it's facing some serious headwinds.
But as we've learned, Pabrai has a knack for seeing value where others see only, risk.
Yeah.
What was his rationale here?
Pabrai recognized that while the long-term trend might be away from coal, there was still, significant short to medium-term demand, especially in emerging markets, and grain industries being one of the largest producer globally was well positioned to capitalize on that demand.
So he wasn't betting on a coal comeback. He was betting on the company's ability to generate cash flow in the present while the world transitions to cleaner energy.
Exactly. He saw an opportunity to buy a well-run business at a discounted price because the market was overly focused on the long-term narrative of coal's decline.
It's fascinating how market perception and actual reality can sometimes be, well, miles apart.
It highlights the importance of, tuning out the noise and focusing on understanding the fundamentals of the business. Pabrai is a master at separating the emotional response from the rational analysis.
Now, shifting gears a bit, Pabrai has also found success in the real estate sector, specifically in Mumbai. His investment in Suntec Realty Limited is a prime example.
Mumbai's real estate market is unique. Unlike many other parts of India, it's incredibly land constrained. So you have a rapidly growing population and limited space for development, which creates a natural supply-demand imbalance, really, and that favors developers.
So it's similar to investing in prime real estate in, say, Delhi or Bangalore. Limited supply, high demand.
Precisely. And Pabrai recognized that Suntec Realty was well positioned to benefit from this dynamic. They have a solid track record of developing high quality projects in prime locations.
So he's not just betting on the broad real estate market. He's being very selective about the location and the company's ability to execute.
That selectivity is a key characteristic of Pabrai's approach. He's not afraid to make those concentrated bets, but those bets are always backed by thorough research and a strong belief in the company's management and business model.
All of this makes sense strategically, but it also highlights another important aspect of Pabrai's philosophy: patience. He's not looking for quick flips. He's willing to hold investments for years, even decades if necessary.
Patience is perhaps the most undervalued virtue in investing. So many people are focused on instant gratification, on finding the next big winner overnight. But real wealth creation, well, it takes time. It's about letting your investments compound, allowing the power of time to work its magic.
That requires a certain mindset, doesn't it? A willingness to delay gratification, to trust in the process, even when the market throws those curveballs your way.
It certainly does. Pabrai often talks about avoiding the temptation to constantly tinker with his portfolio. He believes in making a few well-researched bets and then letting them play out.
Which makes sense if you truly believe in the long-term potential of the businesses you're buying. Now, let's talk about something we touched upon earlier, Pabrai's aversion to complexity. He famously said, don't do math till the fourth decimal to invest. What's the wisdom behind this seemingly simple statement?
He's emphasizing the importance of intuition and common sense in the investment process. While numbers are important, they shouldn't be the sole driver of your decisions. There's an element of art to investing, a sense of understanding the nuances of a business that can't be captured in a spreadsheet.
So it's not about drowning yourself in numbers. It's about understanding the core drivers of a business and assessing whether those drivers are sustainable over the long term.
Exactly. The ability to distill complex situations down to their essential elements is a valuable skill, not just in investing, but in life in general.
And it seems like Pabrai has mastered this art of simplification. He also advises investors to focus on businesses that an idiot can run. What does he mean by that?
It's a vivid way of putting it, really. He's highlighting the resilience of certain businesses, their ability to withstand incompetent management or challenging market conditions. Think about companies like Coca-Cola or Reliance Industries. They've endured, decades of leadership changes, economic downturns and shifts in consumer preferences, yet their core businesses remain incredibly strong.
Because at the end of the day, you're not just investing in a management team. You're investing in a system, a brand, a set of assets that generate consistent cash flow.
Precisely. And finding businesses that can thrive even with mediocre leadership is a key to long-term success in investing.
This brings us back to the idea of separating the emotional response from the rational analysis, which seems critical for any investor.
Absolutely. Emotions can lead to those impulsive decisions, causing us to buy high out of greed or sell low out of fear. I mean, we've all been there at some point.
And that's exactly what we want to avoid. But how do we train ourselves to think more rationally, especially when the market is volatile and our emotions are running high?
That's a great question, and it's something we'll delve into in the final part of our deep dive, along with some key takeaways from Mohnish Pabrai's world of investing wisdom.
Welcome back to Insights That Matters. We've been really exploring this fascinating world of Mohnish Pabrai and his unique approach to investing. And as we enter this final part of our deep dive, I'm curious to learn more about how to practically detach our emotions from this often turbulent world of investing. It's something I think we all struggle with.
It's definitely one of the biggest challenges for investors. But Pabrai offers some valuable insights on how to navigate those emotional waves. He talks about having a rope to climb out of the deepest well. It's a powerful metaphor for developing resilience, really, in the face of adversity.
I love that imagery. Can you unpack this a bit more for our listeners?
Mm-hmm. Pabrai believes that even the most disciplined investors will inevitably face setbacks. The market will test your conviction and tempt you to abandon your principles, really, when things get tough. The rope he refers to is a strong foundation of financial habits that allows you to weather those storms.
So it's not just about picking the right stocks. It's about having your financial house in order even before you start investing.
Exactly. Things like living within your means, avoiding unnecessary debt, and prioritizing savings. These might seem like basic principles, but they're crucial for weathering those inevitable market storms.
It's like building a solid financial house that can withstand the occasional earthquake or a monsoon.
Precisely. When you're not burdened by excessive debt or living paycheck to paycheck, you have more flexibility to ride out those market downturns and avoid making impulsive decisions.
This reminds me of the FIRE movement. Financial independence, retire early. Yeah. It's all about taking control of your finances, so you have the freedom to make choices that align with your values, rather than being dictated by financial constraints.
Absolutely. Pabrai himself has spoken about the FIRE movement and how it aligns with his own philosophy of financial prudence. It's not necessarily about retiring early. It's about having the option to do so, about building a life where you're not beholden to a job or a paycheck.
That sense of freedom must be incredibly empowering, especially for an investor. It allows you to make decisions based on what's best for your long-term goals, rather than reacting to short-term market fluctuations.
Exactly. And it brings us back to that core principle of patience. When you're not constantly worried about, paying bills or servicing debt, you have the mental space to think long term, to allow your investments to compound and grow over time.
Pabrai also emphasizes staying within your circle of competence. He believes in investing only in what you truly understand.
This is about recognizing your own, limitations and sticking to your areas of expertise. If you don't understand a business or an industry, you're more likely to make those emotional decisions based on fear or speculation.
It's like trying to navigate a complex maze blindfolded. You're bound to bump into walls and get lost.
Precisely. By staying within your circle of competence, you're essentially illuminating the path, making it easier to navigate the complexities of the market with clarity and confidence.
So it's not about being a jack of all trades when it comes to investing. It's about becoming a master of a few select areas that you know inside and out.
Exactly. This focused approach allows you to develop a deep understanding of the businesses you're investing in, which in turn makes it easier to stay calm and rational when the market throws those inevitable curveballs. You're less likely to panic and sell when you have a firm grasp of the fundamentals.
This brings to mind another one of Pabray's insightful quotes. Our job is to look for anomalies. He seems less interested in trying to time the market and more focused on finding mispriced opportunities.
That's right. Pabrai believes that markets are generally efficient, but inefficiencies do arise, due to emotional biases or misperceptions. His strategy is to exploit these anomalies, buying when others are fearful and selling when they become overly optimistic.
So he's essentially turning the market's emotional volatility to his advantage. By staying grounded and rational, you can capitalize on the irrationality of others.
Precisely, and this leads us to another crucial takeaway: developing a strong investment philosophy. Pabrai's approach, based on value investing, contrarian thinking, and a long-term focus, it acts like a compass, really, guiding your decisions even when the market gets turbulent.
So as we wrap up this deep dive into Mohnish Pabrai's world, what are the key actionable insights our listeners should take away?
First, build a strong financial foundation. This gives you the freedom and resilience to invest for the long term. Second, define your circle of competence and stick to it. Don't chase trends or invest in things you don't understand. Finally, embrace simplicity and patience. Pabrai's success demonstrates that you don't need complex models to outperform the market.
It's about focusing on the fundamentals, finding good businesses at attractive prices, and letting time do the rest. And with that, we come to the end of our deep dive into Mohnish Pabrai's investment strategies. If you found this episode valuable, be sure to like and subscribe to Insights That Matters for more insightful explorations into the world of investing. Until next time, happy investing.